Okay, so you're the average Joe out there and you're thinking to yourself, I know I need to be investing for my retirement, I just don't know how to do it. I've heard that investing your money in the stock market is going to lead to better growth and investment over time than just, sticking it underneath your mattress or maybe, putting it in the bank in a CD or a safe investment. And then all of a sudden one day a light bulb went off and you decided, maybe I should be investing in S&P 500 index funds. It probably didn't happen that way, but point is, now you've heard of the S&P 500, and you think you know what the S&P 500 is, and that it's gonna lead to greater investment gains for your portfolio than just putting it in a CD, but you don't know really anything else about the S&P 500. In this video, I'm gonna share with you everything you need to know about the S&P 500 index, specifically how to invest in the index fund as an exchange-traded fund, everything you need to know as the average Joe investor out there. Just as a quick spoiler alert for you here, I'm also going to share with you four different, that felt very close to potentially acting like Beyonce, with like the ring on it. Okay, no more of that. I'm gonna share with you 4 different, surprisingly unknown facts regarding S&P 500 index funds that most people, especially the average Joe out there, have no idea about. So make sure you don't drop off of this video early. And plus, by the end of the video, you're not gonna be able to say that you're an average Joe anymore because you know so much about the S&P 500. Let's get started. What's up, you guys? Welcome back to the Average Joe on Money Financial channel, and guess what? My name is actually Joe, and I am truly the average Joe out there. I didn't grow up wealthy. I'm married, I have 4 kids, I live in a very average Joe type of home. The only difference is I kind of have this abnormal and freakishly weird passion when it comes to personal finance and investing. In this video, we're talking about the S&P 500 index fund, and most people understand maybe the basics, but I want to share with you a lot more information, truly everything you need to know. Let's jump right into talking about the S&P 500 and S&P 500 index funds. All right, right off the bat, I'm going to share with you one of those unknown things about the S&P 500. Most people think, okay, S&P 500, that means 500 companies. Yes, but it actually means 505 different stocks. And that's because even though the S&P 500 includes 500 different companies, there are a few different companies that have multiple shares of stock. So Class A, Class B, Class C. So we actually have 505 different stocks in the S&P 500. The S&P 500 includes 500 of the largest, not necessarily the 500th largest, but 500 of the largest companies here in the United States, based on a number of different factors, including profitability, amount of trading volume, market capitalization, in other words, how much the company is worth, and a whole host of other different factors that you as the average Joe don't really care about. Okay, so you're thinking to yourself and you're thinking, well, okay, I know that there's this thing called the S&P 500 index, but how exactly do I invest in it? How does it work? Well, you need to contribute money to the S&P 500 index fund. And then that S&P 500 index fund goes out and purchases shares in all of the 500 companies that are in the S&P 500. So one of the key things you need to understand with the S&P 500 index when you invest in it is you're not going to beat the market. You are matching the market, which is not a bad thing because the market has done considerably well over the past 5, 10, 15, 20, 50 years. Over time, even though there are bumps along the way, up and down and up and down, overall it's gonna go up. All right, here we're at that second big fact, that unknown fact that most people don't know about the S&P 500 index. All of the S&P 500 index funds out there are inherently market capitalization weighted index funds. Even though there are 500 companies and 505 different stocks, they're not all created equally, meaning that all 505 different stocks are not owned equally. They are weighted based on how much they're worth. What that means to you as the average Joe investor is some of the largest companies in the world, companies such as Apple, Microsoft, Amazon, Facebook, Google, Tesla, Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase. These companies own anywhere from 1 to 6% of the index, even though there are 505 different stocks. On the contrary, some of the smallest companies in the S&P 500, you might be thinking of Gap or Unum Group, Xerox Holdings, Under Armour Class A, Under Armour Class C, News Corporation Class B. These companies only hold about 0.01% of the index. So yes, you are diversified when you hold the S&P 500 index, but not quite as diversified as you thought. In fact, the top 10 holdings in the S&P 500 index across all of the different types of mutual funds and index funds you can own are about 28.2% of all of the assets in the fund. The top 10 equals over a quarter of all of the assets in the investment. Okay, so you're the average Joe and you know you want to invest in the S&P 500 index. You're just thinking, how do I do that? There are 3 different ways that you can hold the S&P 500 index. First is through a mutual fund, commonly known as an indexed mutual fund or index fund. Second way is through an exchange traded fund or ETF. And then the third way here is known as a unit investment trust. More on that later. Just a quick note here between the differences between mutual funds and ETFs and unit investment trusts here. With the mutual fund, you might buy a mutual fund shares throughout the day, but the price you get is at the end of the day once the investment company is able to reconcile all the purchases and the sales of shares. So if you buy specifically at 9 in the morning or 10 in the morning or whatever time, you're gonna get the price at the end of the day. ETFs and unit investment trusts, on the other hand, trade very similarly to stocks, in that if the stock is trading at $90 or $120 at 9 a.m. and that's the price you want to get it for, you can buy it at that price, not at the end of the day. If you're looking for more information regarding ETFs versus mutual funds, just take a look at the link in the description and right up here, which you can catch at the end of this video. This video, we are focusing primarily on S&P 500 exchange traded funds and unit investment trusts. Just as a quick reminder here, we've talked about 2 different unknown facts regarding S&P 500 index funds so far. Hold on for a few more minutes here and I promise you're gonna learn something new that you had no idea about S&P 500 indexes. Okay, so there are 3 major players in the S&P 500 ETF space. The first is the Vanguard S&P 500 ETF, ticker symbol VOO. Second is the iShares Core S&P 500 ETF, ticker symbol IVV. And the third is the SPDR S&P 500 ETF Trust, ticker symbol SPY. Third big unknown fact regarding S&P 500 indexes, the SPDR S&P 500 SPY or SPY is a unit investment trust, not an ETF. You're thinking, what does that mean? It actually is quite insignificant and, well, significant as well. Sorry to be a little bit vague there. A unit investment trust is structured very similarly to an ETF, but it is very passive in nature by a rule. It cannot be an actively managed fund. There are such things as actively managed ETFs. They're not very common. They're mostly indexes and passive, but by its very bylaws, a unit investment trust cannot be actively traded. It must be passive and based on a fixed portfolio. Additionally, unit investment trusts have a specific end date, meaning that if we were to get to the year 2118, or I guess I'm not sure what we'll call it actually, 2118, probably 2118. Man, who knows what's gonna happen in 2118. Hopefully by then we actually will have flying cars, and potentially by then we'll also have little tablets we put in the microwave and it blows up into an actual meal. Seriously though, the unit investment trust known as SPY is actually scheduled to be terminated and liquidated on the year 2118, though I'm guessing that there might be some way for it to be extended, which is not something particularly we're gonna be concerned about. But hey man, this video is gonna be evergreen and be here in 2118, in which case people might be freaking out. Just know that potentially it could be extended out further. The other key thing to know about unit investment trusts is the way that they handle dividends. A lot of the companies in the S&P 500 pay dividends to their shareholders. So when the shareholder is an investment company, that company will usually have the ability to take that dividend and immediately reinvest it and then pay it at a later date on a quarterly basis. Because companies pay dividends throughout the year on a different schedule, those dividends can be immediately reinvested by the investment company, and then they can pay that dividend on a scheduled quarterly basis and potentially reap larger gains. Whereas a unit investment trust, by its very bylaws, cannot immediately reinvest dividends. They have to pay that out as cash and hold it as cash until that point. This could potentially lead to lower results. However, the opposite is true. If the unit investment trust is holding onto that cash and we enter a declining market, then maybe that money will be worth more than if it would be if it was immediately reinvested. So ultimately, it has led to very equal returns amongst the 3 different companies. All 3 of these S&P 500 ETFs have an expense ratio, the cost of the management company to manage this investment on your behalf. They're all relatively low. The SPDR S&P 500 Unit Trust does have an expense ratio of 0.0945%, meaning that for every $10,000 invested in this fund, the cost would be $9.45. SPY also has the most trading volume by far, and because of that trading volume, it's also the preferred method for many investors to hold S&P 500 options. It's also by far the longest running S&P 500 ETF. It was opened in 1993. Second on the list here is IVV. The iShares Core S&P 500 ETF, ticker symbol IVV, has an expense ratio. IVV does have less trading volume than SPY, but it has a lower expense ratio, and it does have more trading volume than the third ETF that we're going to talk about here. Third, we have the Vanguard S&P 500 ETF, ticker symbol VOO, and this ETF has the lowest expense ratio at 0.03%, or $3 annually for every $10,000 invested in this ETF. It has the lowest trading volume of the three different index funds. This is not of particular importance though to the average Joe investor out there, because these types of investments should be held for the long term. Hey there, you made it to the fourth big unknown fact regarding S&P 500 indexes, a question that I had for a long time, and that many average Joe's investors out there probably have as well, which is, you'll notice here that for the S&P 500, amongst the three different companies, IVV, SPY, and VOO, they all have different prices. And you might be thinking to yourself, why, if they all track the same index, why do they have different prices? Is it wrong for me to purchase shares of one ETF that is priced lower versus higher? Am I getting duped somehow? Am I not getting as much value for my money depending on which one that I own? And the truth of the matter is that there is no difference. Yes, there are differences in the price, but $100 invested in any one of these ETFs is going to perform exactly the same, because it's all based off of the tracking of the S&P 500, the actual performance of the 500 largest companies. Currently, IVV is priced at $370.31 per share. VOO is priced at $339.16 per share. And then for SPY, it is priced at $369 even. But $100 invested in any one of these three different ETFs is going to get you the same performance. The biggest factor with respect to why those prices are different is because they were not all started on the same day. All three of these ETFs have different inception dates when the fund was started. And so companies that have had a longer time to grow are going to have a larger share price. The biggest difference you'll notice between these three different S&P 500 ETFs is the expense ratio. So if that's a big deal to you, you're dealing with large amounts of money, then VOO or IVV is going to be a great fit for you. However, if you're potentially thinking about trading S&P 500 options as well, then you might get more value out of SPY. Hopefully you found some value out of this video. Make sure to leave your 2 cents in the comments below. Let me know if I answered your questions regarding the S&P 500, if you found some value out of it, something new you learned potentially, and any other educational topics you want to learn about with respect to investing, dividends, personal finance in any way, shape, or form. Make sure to leave your 2 cents in the comments below. That's all I got for you guys. I never want to make these videos longer than they have to be, so I'm going to cut this video off like right now. We done? Cool? Man, I need another beer.